This is Forex trading strategies and analysis for beginners. Learn market strategy basics with this fundamental guide. Written by Matthew G. Carter, read by Eric Boudreau. Introduction. I want to thank you and congratulate you for downloading the audiobook, Forex Trading Strategies and Analysis for Beginners. This book contains proven steps and strategies on how you can start trading in the foreign exchange market. Successful Forex traders are now earning substantial amounts of money every day thanks to the high liquidity of Forex market. However, there are also stories about people losing a lot of money in a single day. It takes knowledge, skills, and discipline in following the right strategies before you can become successful in this platform. Written as a practical guide for people who want to get a jump start in the Forex market world, this ebook can help you learn the basic concepts behind the foreign exchange market, the basic skills you have to learn to become successful in Forex trading, the top strategies, tips, and tricks that successful Forex traders are using, the common mistakes that you should avoid to prevent losing your capital down the drain. Thanks again for downloading this audiobook. I hope you enjoy it. Chapter 1, Forex Market 101. The Forex market refers to the foreign exchange market that is considered as the most exciting and busiest financial market today. Decades ago, this market was only accessible to financial firms, large companies, millionaires, hedge funds, and central banks. But with technological advances such as electronic banking and the rise of the internet, anyone can now trade in the Forex market. The fluctuations in the foreign exchange market every day are usually very small. Hundreds of currency pairs are fluctuating less than 1% daily, and that only represents less than 1% movement in the currency value. Therefore, it's safe to say that this market has less volatility compared to the equities market. Many speculators in the Forex market are depending on the availability of large leverage to increase the value of potential fluctuations. In the retail Forex, the leverage can be as high as 250 to 1, which is regarded as high liquidity but high risk. Moreover, 24/7 trading enables Forex brokers to standardize significant leverage to make the movements more lucrative for traders. The accessibility of high leverage as well as extreme liquidity have driven the evolution of the foreign exchange market and become a viable trading platform even for small traders. It is now possible to trade positions within a few minutes. The price fluctuations in the Forex market depend on the objective evaluation of the demand and supply of the currency pair and can be really difficult to control because of the market size. Even central banks don't have the power to influence currency prices. The Forex market can become a profitable ground for investors and traders. However, this can be only possible if you really understand the basic concepts that influence Forex market. My goal in writing this ebook is to help you develop a basic understanding of the Forex market before you even start trading in the Forex market. In this book, you will also learn the most basic Forex trading strategies that are most commonly used by the successful FX traders. Remember, I don't begin trading without understanding how the market works first, unless you want to learn in the process and risk losing a substantial amount of money. Introduction to the Forex market. The foreign exchange market refers to the actual market where market participants can trade or speculate currencies. It plays an important role in the global economy because the currencies must be converted first before anyone can facilitate business. For instance, if you're located in Singapore and you want to buy 500 sacks of curry powder from India, you may pay an Indian supplier in rupees, INR. This means that you should exchange the equal value of the Singaporean dollars, SGD, into INR. Foreign exchange market is also important for travel and tourism. A French tourist cannot pay in francs to visit the Great Wall of China because francs is not the accepted currency in the country. Therefore, you must exchange francs to yen at the current price. The need to exchange currencies for business and personal purposes influences the high liquidity in the foreign exchange market. In terms of size, the equities market may fade in comparison. Around $5 trillion are traded in the foreign exchange market daily. One defining feature in this worldwide trading platform is that there are no specific organizations or firms that are administering the trade. You can trade in Forex market through digital channels via over-the-counter or OTC transactions. The transactions can happen online in several spots around the world rather than a single central platform. It is also available 24 hours a day and 5 days a week, and the currencies are traded worldwide in top financial centers like London, Tokyo, Frankfurt, Singapore, Sydney, New York, Zurich, Hong Kong, and Paris. This transcends across different time zones, so if the trade is already closing in Hong Kong, the platform is starting in New York. In general, there are 3 options in trading in the Forex market. Number 1, spot market. Number 2, forwards market. And number 3, futures market. Trading in the spot market is regarded as the busiest because this serves as the underlying platform for the forwards and the futures market. In the past, the futures market was the busiest platform for traders because it mainly caters to the private investors as well as traders in an expanded time. But with the rise of online trading, the spot market has enjoyed a considerable flow in investments and now goes head-to-head with the futures market as one of the most active trading platforms for individual investors and speculators. There is a high chance that your idea of the Forex market is the spot market. The futures and forwards markets are usually the ideal platform for companies who need to hedge their risks to a specific date in the future. The spot market. In general, the spot market is the platform where you could buy and sell currencies according to the prevailing rates. The price can be affected by the present demand and supply, and is also affected by various factors like currency pair performance perception, current interest rates, economic performances, and political situations, international and domestic. The spot deal in the spot market refers to the finalized deal. This is the dual-channel transaction in which one party will provide an agreed currency rate. The transaction is paid when the position is closed. While the spot market is known as the platform where you can deal with Forex trade in the present, the trades may take around 2 or 3 days to be settled. Forwards and future markets. There is no actual trading of currencies in the forwards and future markets. Instead, market participants are dealing with contracts that significantly claim a specific type of currency and specific unit price. The settlement is specified at a future date. In the futures market, the contracts are traded based on a standard size and the settlement date for public financial markets such as Mercantile Exchange in Chicago. In the U.S., the futures market is governed by the National Futures Association. These contracts have specific details, including the units for trading, data settlement, and the price increases. The exchange serves as a representative for the trader for clearing a settlement of the contract. In the forwards market, the contracts are traded over the counter between 2 players who will specify the terms based on their agreements. International companies are mainly trading contracts in these markets to hedge against fluctuations in the exchange rate. Forex speculators are also participating in these trading platforms. Brief history of Forex market. With the worldwide scale of the Forex market, you need first to understand the important historical events which are related to the currency system we use today, as well as how the Forex market has evolved over time before you're trading or investing. The gold standard. The gold standard model was established in 1875 as a global currency model. This became one of the early milestones of the Forex market. Prior to this standard, countries in the 19th century used precious metals like gold or silver for international payments. The main disadvantage of this system was the volatility of gold and silver prices as they fluctuated by the supply and demand. For example, depletion of primary gold reserves in a specific country can have lasting effects on prices of gold. In the gold standard, governments or companies have to agree to convert their currencies into a specific equivalent of gold and vice versa. Hence, the currency should be backed by actual gold reserve. And so the governments during the 19th century have to secure sufficient gold reserves to catch up with the demand for exchanging foreign currencies. Leading world economies at that time, such as Great Britain and China, have already established the value of currency. Eventually, the distinction in the price of gold between 2 currencies was regarded as the rate of exchange between the 2 currencies. This became the early standard for trading currencies. But on the onset of World War I, the gold standard eventually became obsolete. Because of imminent danger from the Axis power, many European countries had to finance massive military projects. Gold reserves were not enough, as they needed to complete the project within a limited time frame. After the war, some countries re-established the gold standard, but most economies discarded the system again when war erupted again in the 1940s. However, gold continues to be valued as the preferred channel for international payments. the United States dollar standard. Before the end of World War II, the Allied forces deemed it crucial to establish a currency system to solve the downsides of the gold standard. So in 1944, a meeting was convened in Bretton Woods, New Hampshire, to deliberate a new currency management system. The resulting system was later on called the Bretton Woods system. The Allied forces agreed to adhere to the following: use a fixed rate system for trading currencies, use United States dollars as the primary reserve currency to replace gold, form 3 worldwide agencies to manage economic activities: the International Monetary Fund, IMF, the World Bank, and the General Agreement on Tariff and Trade, GATT. Bretton Woods became the birthplace of the US dollar as the global reserve currency. Furthermore, USD was also established to be the only currency to have an actual equivalent of gold reserves. As such, the US had to execute a series of balancing and deficit payments to make sure that the currency is the most stable in the world. However, in the 1970s, the US gold reserves were not sufficient to sustain the economic activities of the world. In 1971, US President Richard Nixon ended the Bretton Woods system by officially declaring the termination of the gold reserve system for the USD. In spite of the fact that the Bretton Woods system was a short-lived system, it still made an important contribution to the present-day world economy. When the Bretton Woods disintegrated, world governments gradually embraced the floating rates for the foreign exchange. But in 1976, the Jamaica Agreement led to the permanent elimination of the gold reserve standard. However, this doesn't mean that the government totally adopted the floating rate system. Many governments are still using floating rates, pegged rates, and dollar rates. This exchange mechanism is established if the exchange rate of a currency is permitted to freely change in value according to the market forces of demand and supply. However, the central bank of the state could still interfere to ensure the stability of the currency if the exchange rates experience high fluctuation. For instance, if the currency of a country is falling too much, the government may choose to increase short-term interest rates. This will in turn cause the currency to slightly appreciate. But take note that this is a very basic explanation, as central banks usually employ several tools for currency management. Pegged rates. Pegging refers to the practice of a country establishing a fixed exchange rate for another currency so that it becomes more stable compared to the regular floating rates. In particular, pegging will allow the currency of a country to have a fixed rate for the exchange with one or a specified group of foreign currencies. In addition, the currency may only fluctuate if there is a change in the pegged currencies. In 1997 and 2005, the Chinese government pegged its currency to the US dollar at USD 1 to CNY 8.28. The disadvantage of pegging is that the value of the currency is now on the discretion of the economy of the country. For instance, when USD significantly increases its value against other denominations, the value of the Chinese yen will also increase. Dollarization. Dollarization happens if a country decides not to use its own currency and adopts the United States dollars as its currency. Even though dollarization normally bestows a country with higher stability, the disadvantage is that the central bank of the country cannot make any form of monetary policy or print its own money. Countries that adopted the US dollars include Zimbabwe, British Virgin Islands, Palau, Marshall Islands, El Salvador, East Timor, and Ecuador. Reading currency quote. When you are quoting a currency, you are doing it in relation to the currency of another country in a way that the value is defined by the other currency's value. Hence, if you want to know the Forex rate between Swiss francs, CHF, and Chinese yen, CNY, the Forex quotation will look like this: CHF/CNY equals 6.95. This is known as the currency pair. In this pair, CHF is the currency base, while CNY is the counter currency. The former always has a value of 1 unit, and the latter is what the one base unit is equivalent to in its denomination. This effects pair means that CHF1 equals 6.95 Chinese yen. So if you have a Swiss franc, you can buy 6.95 Chinese yen. Take note that the FX quote includes the currency symbol for the currency pairs. You can quote a currency pair either indirectly or directly. A quote is referred to as an indirect. The local currency is the currency base, while the direct quote is basically a Forex pair wherein the domestic currency is the quote currency. Therefore, if you're looking for the United States dollar as a domestic currency and the Japanese yen as the foreign currency, an indirect code will be JPY/USD, while a direct quote will be USD/JPY. In direct quotation, the quote currency could vary, while the currency base has a different value of 1 unit. Meanwhile, in the indirect quote, the domestic currency has a default value of 1 unit, while the foreign currency has a variable value. For instance, if the Japanese yen is the domestic unit, a direct quote will be 109.37 USD/JPY, which means that 1 unit of USD can buy JPY 109.37. The indirect for this will be inverse 1/109.37, 0.0091 JPY/USD, which means with 1 JPY you can buy USD 0.0091. In the FX spot market, most currencies are traded against the USD, and this is often referred to as the currency base. These are the direct quotes and are true to the above CHF/CNY that indicate CHF is equal to 6.95 CNY. You must remember that not all currencies have the USD as the base. The currencies used by the British Commonwealth, such as the New Zealand dollar, Australian dollar, and the British pound, are all identified as the currency base against the USD. This is how we also quote the euro. For these situations, the USD is positioned as the counter currency, and the FX rate is known as the indirect. Hence, EUR to USD is quoted as 1.19, because 1 unit of euro can buy 1.19 USD. The exchange currency rates are quoted up to 4 decimal digits. One exception of this is the JPY, because this currency is quoted only up to 2 decimal digits. If a currency quote is given without the USD as a component, this is known as cross-currency. The most popular cross-currencies are EUR/CHF, EUR/JPY, and EUR/GBP. In general, currency pairs expand the trading horizons in the FX market, but you should bear in mind that they're not as popular compared to the currency pair that uses USD as the currency base. Buying and selling price. Like in stock markets, if you're trading currency pairs, you have to refer to the buying rate, bid, and selling price, ask. Take note that these are still in relation to the currency base. If your strategy is to go long, trading on a currency pair, and asking price refers to the rate of quote currency, which should be paid so you can purchase currency-based units, or how much the market is willing to sell currency-based units in reference to the currency quote. On the other hand, when you go short, the bid rate signifies the amount of currency quoted you can get when you sell currency-based units, or how much the market will be willing to shell out for the currency quoted in reference to the currency base. Remember, the figure on the left of the slash is the bid rate, while the asking price is located after the slash. Take note of this customary that the full price's last 2 digits are quoted. The bid is also smaller compared to the asking price. Take a look at an example below. USD/CHF equals 1.3000/05. Ask equals 1.3005. Bid equals 1.3000. Buying this FX pair signifies that you like to purchase the currency base, and so you have to refer to the asking price to know the value in Swiss francs the trade will charge for USD. Based on our asking price, you can purchase $1 with 1.3005 Swiss francs, which is the currency that you are quoting. You have to refer to the bid if you want to short this FX pair, or simply you want to put the currency base in the market using the quote currency. This signifies that the Forex market will purchase $1 currency base for a price that is equivalent to 1.3000 Swiss francs, which is the currency that you are quoting. The currency base, whichever you are quoting first, always refers to the one in which we are conducting the transaction. This means you can either buy or sell currency base. You can refer to the specific currency pair rate in order to find the price depending on what currency you like to use for selling or buying the base with. Spreads. The difference between the ask price and the bid price is known as the spread. For example, in our currency pair, USD/JPY equals 109.2418/21. The spread is 0.0021, or 3 points or pips. Even though the difference may be very small for the untrained eye, even the slightest movement could lead to thousands of profits or losses. This is one reason that my speculators are always monitoring the movements in the Forex market, as even the smallest point change could lead to substantial profits. Pips. Pips refer to the lowest value that the Forex price could move in a Forex quote. For example, for USD, EUR, GBP, and CHF, a pip is equivalent to 0.0001. And with Japanese yen, a pip is equal to 0.01. Because, as we've noted earlier in this chapter, yen is quoted up to 2 decimal points only. Hence, in a Forex quote, USD/EUR, the pip will be 0.0001 euro. Many currencies could be traded inside a range of at least 100 to a max of 150 pips in a single day. The futures and forwards markets. Bear in mind that an important differentiating factor between the Forex markets is how we quote currencies. Within the forwards or futures markets, the currencies are always traded against USD. Therefore, the pricing is conducted in terms of how many USD you have to purchase a certain currency. Take note that in Forex spot market, some currencies are traded against USD, while there are also quotes where USD is traded against them. Hence, the quotes from the futures/forwards market, as well as the spot market, will not usually become aligned to each other. As an example, in the Forex spot market, the euro is quoted with the US dollars as EUR/USD. This is also the manner used for quoting currencies in the futures and forwards market. Hence, if euro becomes stronger than the US dollar in the spot market, there's also a higher tendency to rise in the futures and forwards markets. Meanwhile, in the case of USD/JPY currency pair, USD is quoted against JPY. The current quote in the spot market for the FX pair is 110.27, which means that $1 will be able to buy 110.27 Japanese yen. But in the futures FX market, the quote will be 0.0090, or 1/110.27. which means that 1 Japanese yen will purchase 0.0090 US dollars. Hence, a slight increase in the USD/JPY in the spot market will result in a fall in the yen futures rate, since USD will be stronger against the yen, and so 1 unit of yen will buy fewer dollars. Currency cross rates. Even though most of the currency trading includes USD, top foreign currencies can be traded among themselves. Currency cross rate refers to the currency trading pair that does not include USD. For example, a Japanese company with sales in New Zealand may wish to convert the New Zealand dollars it has received back into Japanese yen. There is no need for the company to convert the payments to NZD into USD before they can convert USD into JPY. Rather, the Japanese company could use the NZD cross rate to convert the NZD directly into yen. As you already know, the USD and the GBP are among the most heavily traded currencies in the world. Considering that by definition, USD is not included in the currency cross rates. The most heavily traded cross-currency pairs include the euro. Cross-currency rate pairs are also quite popular among other top foreign currencies such as the Swiss franc, Chinese yen, and British pound. Other currencies that are less liquid usually don't actively trade except against the USD. If you are interested in transacting between these two currencies, you might need to complete the 2 transactions. First, you have to convert the foreign currency into USD, then convert the USD into your preferred currency. Chapter 2. Basic Forex trading skills you need to learn. There are many ways to become a successful Forex trader. For example, if you want to be a Forex trader under a financial arm, they usually hire people who have a strong background in hard sciences, engineering, or math. In starting your career as a Forex trader, there are basic skills you need to learn. This includes the following. Number 1, analytical skills. Number 2, research skills. Number 3, focus and control. Number 4, money management. And number 5, psychology. Analytical skills for Forex trading. Analytical thinking is a basic skill that every Forex trader should have. You must be able to analyze available data within a limited time frame. Forex trading is a numbers game, and the platform is filled with patterns, indicators, and charts that you need to analyze quickly. You also need to develop your analytical skills so that you can easily identify trends in the Forex market. There are 2 types of analysis that you need to master with Forex trading: technical and fundamental analysis. Technical analysis. Among the fundamental concepts of technical analysis is that the future price movement could be predicted by looking into the past movements. Because the foreign exchange market is a 24-hour market, you get a chance to assess a huge volume of data which you can use to measure the price activity, which increases the statistical significance of the projection. Many investors and traders in the Forex market are using technical tools like indicators, charts, and trends. In general, it is crucial to take note that technical analysis interpretation could stay the same regardless of the assets that you're keeping track. In this chapter, we will discuss the most popular Forex strategies based on technical analysis. In doing technical analysis in the Forex market, you need to determine if a currency pair will trend in a specific direction or if it will remain in the range or go against the trend. The common way to figure out these traits is to place trend lines, which links historical levels that have avoided a rate from going lower or higher. These resistance and support levels are popular among technical traders to find out if the current trend shall continue. Common indicators in technical analysis. Forex traders who prefer technical analysis use various indicators alongside resistance and support levels to help them in projecting the future direction of exchange rates. Take note that learning how to understand different technical indicators is crucial and may require further study on your part. Among the indicators that you should learn well include stochastics, moving average convergence divergence, MACD, moving averages, Fibonacci retracement, and Bollinger Bands. Take note that these tools are not often used as an independent indicator, but rather alongside chart patterns and other indicators. Fibonacci indicator. The Fibonacci's indicator is a common indicator used in a technical analysis in the Forex market. This strategy heavily depends on the pullback, and to completely understand how this works, you should revisit your understanding of the Forex trend. In looking at every price action separately, it is quite difficult to look for a pattern. Taking a closer look at the larger picture will allow you to identify the trends. For hundreds of years, the Fibonacci ratios and numbers have been popular among artists and mathematicians. These figures signify many things in mathematics, in nature, and even in financial markets. Although Fibonacci is a classic concept in mathematics, you don't need to be well adept in the subject, so you can use these figures in calculating projections in the Forex trading platforms. All you have to do is make a decision according on the lines that appear on the charts. By taking a closer look on how far the pullback has reached on the Fibonacci scale, we could figure out that if the price could pull back again or turn into a bearish or bullish trend. As long as the price will remain above the specific line, you could expect the trends to pull back through a rising trend. When the price crosses the line, you should treat it as a beginning of a bearish trend that will indicate that it is time to close the position. Horizontal levels. Horizontal levels are among the most simple but quite useful concepts trading in the Forex market. These are fundamentals in most Forex trading strategies and could help you in studying charts. But you can also use them as a separate strategy instead of a mere tool to ride along with other strategies. In monitoring the most clear-cut price actions and identifying the horizontal levels, you could make profitable trades. In completely becoming familiar with the horizontal levels of advanced charts, you can identify trends that you might have otherwise ignored. Swing points. The ideal method in using horizontal levels to your advantage is through the analysis of swing points. which refer to the points where there is a change in trends. By marking the horizontal levels on these places, you can find the prices where there could be a likely change in the trend. Ranging markets. Horizontal levels can be used in ranging markets, which refers to the condition in which the price has clear lower and upper boundaries. By monitoring the price when it is approaching a limit, you can project with precision the price could be more likely to continue in the next trend. Divergence. Traders, as well as analysts of financial markets, aside from the market fundamentals, are using several indicators to determine what could happen to the price of a specific instrument. These indicators will provide you with the basic method of recognizing patterns and projecting which is the way price could trend. Using these indicators is what makes signals in the Forex market helpful, as you can use them for real-time analysis of the price action. Fundamental analysis. In the stock market, fundamental analysis measures the true value of a company. A fundamentalist, one who mainly uses fundamental analysis, bases his decision to invest or trade in stocks according to calculation. Somehow this is similar in the foreign exchange market, where fundamentalists are also looking into the true value of the countries and their currencies. They're also watching out for economic announcements in order to gain an idea of the true value of the currency. In general, geopolitical events, economic data, and news reports from a certain country are regarded similarly to announcements about stocks and companies used by investors to gain insight of their true value. The value may change over time because of several factors, including financial strength and growth. Fundamentalists are focusing on this data to assess the currency of the countries in the currency pair that they're interested in. Forex carry trade. The Forex carry trade is an investment strategy wherein a trader is offering a currency that has a lower interest rate and buys a currency with a higher interest rate. To put it simply, you are lending currencies at a higher rate to borrow a lower rate. In using this strategy, you can make profits through the difference between these two rates. Trading the news. Significant news events around the world could have a large impact on the foreign exchange market, which usually renders all analysis meaningless. Take note that the Forex market is a 24-hour market, and there is no way to schedule the announcement of news. Changes in the market according to the economy and data can hit any type of trader wherever you are in whichever currency you choose to trade. Short-term news trading. Short-term news trading is a bit more challenging because of the volatility as well as the tighter stops. More often than not, minutes before and after, there are whipsaws with the rate frantically moving in both directions. Short-term news trading is also divided into several strategies. One method is to sell the currency spike after a bad news. There are instances that even after bad announcements, the price slightly increases for several seconds or even minutes. This is the best time to sell, particularly if this is at some significant resistance or level. Long-term news trading. In looking for long-term trading opportunities according to economic news, it is crucial to assess both the previous and current data. This is because there are instances that news may take weeks or months to be significantly absorbed by the market. You can use the information to see a larger picture and the impact that it may have on the currency you want to trade. The long-term trends are built by fundamental factors that are founded on numerous economic pieces over a specific period of time. For example, the currency pair GBP/USD has started an uptrend a year ago, and this trend continued ever since. On the other hand, EUR/GBP is following a falling trend for some time now. Market sentiment. By now, you already understand that trading in the Forex market can be difficult, especially for beginners. Market sentiment refers to the momentum of the market. All Forex traders have their own style of trading. Some may be bearish, and some may be bullish. Hence, market sentiment is the style of the different traders combined, which produces the general condition of the market. There are instances that every indicator is pointing to a specific direction, but the market is moving in the opposite. There are instances that the fundamental condition of the economy can be considered as bearish for a particular currency, and nevertheless, it keeps on fluctuating upwards in a comparison with other currencies. Price action. Focusing on a single currency pair one at a time is a good way to be familiar with the general market sentiment. Through this, you can gradually master reading currency pairs. Many lucrative Forex traders are successfully trading according to their price and action sense. In this strategy, you must keep track how quick a specific pair is moving in the two directions. When the uptrend is quicker than the downtrend, it means that the market is more open to buy immediately, which indicate a more bullish general market sentiment. In addition, you can also monitor how a currency pair responds to financial news that is relevant for a currency pair. For instance, if the economy in the UK is good, the GBP/USD could bounce up according to the recovering economic data. This signifies a more bearish general market sentiment. Research skills. When trading in the Forex market, you should not trade on an impulse. You must be confident with your strategy, and you can do this through research. In the past, you could do a background check of the hottest currency pairs by reading books, newspapers, and other traditional forms of information sources. With the advent of the World Wide Web, there are now countless sources of information that you can use for your research. However, not all of these sources are reliable and can guide you to become a successful Forex trader. In choosing a source to consult, make certain that this covers the currency pairs to buy, or if it is time to sell your currencies based on different factors such as technical and fundamental analysis. There are also reliable newspapers and publications that you can read, which include interpretation of global news and how current events could affect the Forex market. Forex trading involves revisiting past basic economics, because politics can also affect the behavior of Forex players. Hence, it is crucial that you are updated with significant non-financial news from around the world. In order to develop a solid foundation in Forex trading, you must be updated with important technical and fundamental developments in the industry. Successful Forex traders usually have a thirst for information as well as the drive to look for all relevant data which could affect the trade. Many traders even maintain a monitoring platform to keep up with major news breakthroughs that can have considerable impacts not only on the Forex market, but also in the global financial scene. Focus and control. Focus is another important skill for Forex traders, which can increase the more that you practice it. With the emergence of numerous online resources promising to guide you on Forex trading, you should be able to develop how to identify and focus your lens on the actionable trends that could affect your trade. There are Forex traders that are only focusing on specific types of currency pairs so they can put all of their efforts in projecting the movement of the trade. By focusing on these currencies, traders can develop a competitive advantage compared to the traders who don't focus on their trades. Meanwhile, a successful trader should also learn how to control their emotions and follow specific strategies or trading plans. This is crucial in handling risks in Forex trades by taking profits at specific points or using stop losses. There are strategies in place that allow traders to lose a bit on bad trades but gain more revenues from ideal trades. Bad traders are usually affected by their emotions, which influence the strategic implementation of their trading plan. Risk management. Risk management is a skill that you should master to safeguard your trading capital from losses. This must be integrated in your trading strategy as early as you can in your Forex trading career. Risk management covers strategies such as risk to reward, scaling trades, and stop losses. Mastering this skill will allow you to obtain higher profits and prevent losing money. For instance, many successful traders don't risk more than 2% of their fund in a single trade. This will safeguard your account from any significant downturn and will allow you to safely trade using leverage. Psychology. Successful traders are not only adept in the mathematics behind the Forex trading platform, they are also masters of understanding the psychology of people behind the trade. Aside from observing the possible behavior of market players, a Forex trader should also overcome psychological aspects such as greed and fear. In Forex trading, you should learn how to follow the rules of the game without allowing your emotions to distract your game plan. It is not easy to become a successful Forex trader, but if you work through your plan and master yourself, you can win the game through skills and discipline. Chapter 3. Top Strategies in Forex Trading. Aside from technical analysis and fundamental analysis, there are other strategies that are commonly used by Forex traders today. This includes the following. Number 1, carry trade trading. Number 2, pivot trading. Number 3, position trading. Number 4, reversal trading. Number 5, retracement trading. Number 6, breakout trading. Number 7, swing trading. Number 8, momentum trading. Number 9, range trading. And number 10, trend trading. In this chapter, we will discuss each trading strategy briefly, so you can choose the best strategy for you and later expand on your knowledge of these strategies. Carry trading. Carry trading is a common Forex trading strategy which aims to increase profits through the differences in interest rates between two currencies. Usually the currencies you buy and hold can pay for the interest rate between banks of the two currencies. In carry trading, you need to search a currency of a country with a lower interest rate so you can purchase a currency by paying higher interest rate. Forex traders could employ a strategy for trend trading in combination with carry trading to make sure that the price differences as well as the interest earned could complement each other and avoid offsetting their benefits. Pivot points trading. In pivot trading, you need to identify the support and resistance levels according to the average of the past Forex session's low and high closing rates. This average can help Forex traders project the most likely lows and highs as well as market reversals in a matter of days. Since averages are common in the Forex market, these are regulated as a safe range for medium-term to long-term trading. These averages can also help a trader to determine if a new breakout is happening or a specific range is on the brim of being surpassed. Position trading. This Forex trading strategy is ideal for traders who are looking for long-term gains, which could play out over several periods of months or even years. Traders who are into position trading usually base their plans on long-term trends of various economies. They also usually operate with minimal levels of leverage and smaller trade sizes with the projection of possibly gaining revenues on large price movements. Position traders are often adept in using technical indicators as well as fundamental analysis in selecting their exit and entry levels. This form of trading may need higher levels of patience as well as stamina and may not be ideal for those who are looking for quick profits. Reversal trading. Reversal trading refers to the form of trading that allows traders to look for a reversal in price trend, with the objective to guarantee entrance into trade ahead of the market. This trading strategy is regarded as risky and not ideal for beginners. It can be difficult to spot true reversals, but these are also more rewarding if they're properly projected. Traders are using different tools to identify reversals like volume indicators, momentum, or visual cues on charts like head and shoulder trends, as well as triple tops and bottoms. Retracement trading. Retracement trading is based on the concept that prices don't flow in perfect lines between lows and highs, and typically makes some type of slowdown and may even change the direction between strong resistance and support levels. Forex traders will usually choose a certain portion of movement as an indicator of confirmation, like 50%, or depend on Fibonacci ratio of 61.8%, 38.2%, or 23.6% to help in identifying optimal points for exiting and entering trades. Breakout trading. In breakout trading, you need to determine a trade entry point in a specific breakout from a certain trading range or in the prior range. When the price breaks in a higher range from a certain resistance level in a chart, you need to buy currency with the projection that it will persist its upward direction. Likewise, when the price breaks in a level support inside a range, the trader can sell with the objective of buying the currency again at a more reasonable rate. Swing trading. This medium-term Forex trading strategy is typically used over a period of days to weeks. Swing traders will usually look to set up trades on swings to lows and highs over a certain period of time. Its purpose is to filter out erratic movements in the price, which is common in intraday trading. This is also used to prevent setting narrowly placed stop losses, which can force the traders to stop out a trade for a short-term market flow. Momentum trading. Momentum trading is based on the concept that strong price movements in a certain direction are possible indicators that there is a persistent price trend in a particular direction. Likewise, weakening movements signify that a trend has already lost its strength and can be headed towards reversal. Momentum trading may also consider both volume and price and usually use analysis of graphic tools such as candlestick charts and oscillators. Range trading. Range trading is a basic strategy that is based on the concept that prices can typically hold inside a steady and predictable range for a specific period of time. This is specifically true in markets that involve steady and predictable economies, as well as currencies that are often stable. Forex traders who are into range trading depend on being able to regularly buy and sell at expected highs and lows of support and resistance, sometimes doing several trades in a day. Range traders also use some of the same tools as trend traders to look for ideal exit and entry levels, which include the relative strength index, as well as the stochastics and commonly channel index. Trend trading. Trend trading is a popular Forex trading strategy that involves spotting downwards or upwards trend in a price movement of a currency and selecting trade exits and entry points according to the position of the primary currency inside the trend, as well as the relative strength of the trend. Take note that the recent trends can be effective indicators of where rates are likely to go upward and where to best set up exits and entry points for the trade. Trend traders are also using different tools to assess the trends like stochastics, directional indices, volume measurements, relative strength indicators, and moving averages. Chapter 4. Tips and Tricks in Forex Trading. Tips and tricks in Forex trading. It is true that the Forex market is filled with ratios, charts, and numbers. However, this game is more of an art than a science. Similar to artistic endeavors, talent is a strong foundation, but it will only get you so far with your effort and improvement. Successful traders develop their skills through discipline and practice. They perform self-evaluation to see what is driving their trades and learn how they can keep greed and fear out of the equation. In this chapter, we will discuss the tips and tricks that a beginner can use to become successful in the Forex trading. Number 1. Establish your goals and select a trading style that is compatible for your personality. Before beginning a single trade in the Forex market, it is crucial that you have some concept of where you want to go and how you can work every day to achieve this destination. Also, it is crucial that your goals in mind are clear as to what you want to achieve. You should also be certain that the trading strategy you choose will help you achieve your goals. Take note that every type of trading strategy requires a specific approach, and every style is suitable to a different profile. For instance, day trading can be ideal for you if you are not comfortable with an open position in the market. Meanwhile, if you have capital that you believe will take advantage for the appreciation of the trade over a period of several months, then position trading might be ideal for you. Just make certain that your personality is suitable for the trading style that you do. Number 2. Select a trading methodology and be consistent. Before you start any trade, you should have enough knowledge about the Forex market so you can execute your trades with confidence. You should know the specific information you need to know so you can make the best decision about whether to exit or enter a trade. Some traders are using technical analysis, while others prefer to look at underlying fundamentals of the economy of the company, and then use charts to find out the best time to enter the trade. Take note that market fundamentals can drive the long-term trend. Chart patterns, on the other hand, may provide you with short-term trading opportunities. Just be consistent regardless of the methodology that you prefer, and make certain to be flexible as well. The methodology must catch up with the changing Forex market platform. Number 3. Carefully select your entry and exit frames. Most beginners in Forex trading experience confusion because of the opposing data that they may encounter in evaluating charts in various time frames. For example, the information that can be extracted from an intraday chart could indicate a sell signal, which may show up as a buying signal when viewed in a weekly chart. Hence, if you depend on an intraday chart and using a weekly chart to look for the best time entry, make certain that the two charts are in sync. When the weekly chart indicates a buying signal, you should also wait until the daily chart also shows a buying signal. Number 4. Work on the trade expectancy. It is crucial to make sure that whichever system you use, it should be reliable. You can do this by calculating on the expectancy. Using this formula, You can revisit past trends and gauge all of the trades you won against all of the trades that you lost. Then you can figure out the profitability of the winning trades against how much you have lost on losing trades. Check out your previous 10 trades, then figure out if you have made profit or loss. Write the trades down and get the total of all the trades you won, then divide the answer by the number of trades you lose. Below is the formula. W refers to the average winning trade. L refers to the average losing trade, while P refers to the percentage of winning ratio. E equals 1 plus W slash L x P minus 1. For example, in your previous 10 trades, you have won 7 trades and 3 losses. 70% is your win ratio. If the 7 trades gain $3,000, then the average win is 3,000 slash 7 equals $428.57. If your total loss was $1,000, then your average loss is 1,000 slash 3 equals $333.33. In using the formula above, you will get E equals 1 plus 428.57 slash 333.33 times 0.7 minus 1 equals 0.60 or 60%, which means 60% reliability of the system can provide you with 60 cents on a dollar in the long run. Number 5, create positive feedback loops. You can create a positive feedback loop if your trades are implemented according to your strategic plan. A positive feedback pattern can be created if you execute a trade based on your plan. Success can breed success, which could in turn provide the confidence you need, especially if the trade is profitable. The habit of sticking to your plan, despite of some losses that you may encounter in the process, can still result to positive feedback loop. Number 6, concentrate on your trading strategy and don't be afraid of small losses. In playing the Forex market, you should take note that there is a risk to lose all of your money. Hence, you should only use your excess money and not gamble your money for necessities such as college fund. Successful traders consider their trading fund as a game fund. When the game is over, the money is all spent. This attitude can help you to be more positive while trading in the Forex. Psychologically, you can be well prepared to accept even small losses. This is crucial in how you can handle risks successfully. You can become a successful Forex trader if you concentrate on your trades and learn from small losses. Chapter 5. Common Forex trading mistakes to avoid. While you can make substantial gains from Forex trading in a single day, there is also a risk of losing all of your money in a single trade. This is especially true if you don't know how to use leverage for your advantage or commit specific practices that if you use could end up draining your fund. There are common Forex trading mistakes that Forex traders usually make in the hope to gain high returns, but end up losing a lot of money. With knowledge, discipline, and alternative methodologies, you can avoid these trading mistakes. Averaging down. Beginners in the Forex market usually experience difficulty when it comes to averaging down. Most of these traders commit this mistake unintentionally. The primary concern with averaging down is not only it can cost you money but also time, which can be allocated on the other trades that can provide you better returns. Meanwhile, a higher return is required on remaining fund in order to initiate replenishment. If you lose half of your capital, it will require 100% return in order to gain back your capital to its original level. Losing huge chunks of capital on a single day or in a single trade can easily cripple down the growth of your capital and time. While averaging down may work on special circumstances, this strategy will eventually result to margin call or substantial loss, because a trend can only sustain itself depending on the liquidity of the trader. News prepositioning. While you may be aware of certain news events that can influence the market, the direction is still uncertain. You might even be confident on the possible news such as the movement of interest rates in a country, but there is no way to accurately project how the exchange will behave after the news. There are also added news or indicators behind the news announcements, which could make the movement highly illogical yet possible. All sorts of orders can also hit the market and stops can be triggered on different sides of the currency pair. This usually leads to a back and forth action prior to the emergence of a trend. Taking a position prior to a news announcement can substantially damage your probability of winning the trade. Quick trading after news announcement. A news announcement hits the market, and then the market players will start to react. At first, it seems like a no-brainer to ride the bandwagon so you can take advantage of the market sentiment. If you do this without a plan and without formidable trading strategy, you may end up losing the trade. News releases usually result to fluctuation in the market, mainly because the hairpin turns and lack of liquidity in the market assessment of the report. There are even trades that are already in the money and end up quickly turning and bringing large losses as significant swings happen around. Liquidity is crucial for these times, which can mean that losses can probably be much more than expected. Successful traders usually wait for some time so the volatility could subside so there will be a definitive trade after the hype. Trading more than 1% of your capital in a single trade. Take note that higher returns doesn't always mean higher risk. Most traders who risk huge amounts of money on a single trade will typically lose in the long term. A common rule of thumb is that you should only risk not higher than 1% of the capital on one trade. If you have accumulated enough experience and skills in Forex trading, you can increase your limit to 2%. You must also establish a daily maximum risk, which can be for beginners 1% of the capital or equal to the average daily profit in a month. For instance, if you have $100,000 in your account, without the leverage, you should not lose $1,000 in a single day. With this strategy, you can make certain that no single day of trading or single trade could affect the account substantially. Unrealistic projections. Regardless of your dreams or goals in Forex trading, the market is insensitive to what you expect. Before you even start trading, you should accept the fact that the Forex market could be illogical and volatile. In order to avoid disappointments from unrealistic expectations, you should have a trading plan and stick to the strategy when you are doing the actual trade. If the results are steady, still stick to your trade plan. In the Forex market, even a minor gain could become substantial in the long run. As your fund grows over time, the position size could be increased so you can bring in higher returns. Also, if you want to test a new strategy, you should only do so with minimal capital. You can allocate more capital into a strategy if you see positive results. The Forex market is also quite volatile near the open. You can use certain strategies in the opening, which are not ideal near the closing. The market may become more stable as the day progresses, and there may be a pickup in action towards the close that may require another form of strategy. The key in this fluctuating market is to accept what is provided by the market and don't expect too much from the system. Conclusion. Thank you again for downloading this audiobook. I hope this book was able to help you gain a basic understanding of Forex trading and start earning money every day. The next step is to open your account and face the challenge of winning Forex trades. Finally, if you enjoyed this audiobook, then I'd like to ask you for a favor. Would you be kind enough to leave a review for this book? It'd be greatly appreciated. Thank you and good luck. This has been Forex Trading Strategies and Analysis for Beginners. Learn market strategy basics with this fundamental guide. Written by Matthew G. Carter, read by Eric Boudreau.